Good morning. Welcome to Stock Market Today, Thursday, February 4th, 2021. This is your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. Find me on Twitter. I'm at Dan Russo _CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for that free email. Get a lot of the content from this show from that email. We also give you daily stock ideas to consider, and that hits your inbox every trading day before the market opens. So U.S. equities modestly higher yesterday, though they did weaken into the close, and the Qs actually closed lower on the day. Rising Treasury yields are in focus once again. As treasuries continue to be under pressure, the curve continues to steepen. Now, recall that we have been bearish on treasuries across the curve for quite some time now. Dollar was stronger on the major crosses. Kind of an interesting development, actually, up about 1% on the week for the dollar. Gold was up 10 basis points. Silver, about 2% to the good. Crude oil up 1.7%, and is now up 7% past 3 sessions, right? Anybody who's been reading my notes has known since crude broke 42 to the upside that we were playing for 60, and we're on our way. As we get to the desk this morning, S&P futures are flat. NAS futures a little bit higher, and that's after Asian markets were weaker overnight. European markets slightly better here this morning. Treasuries are unchanged to slightly weaker once again. The dollar is stronger on the major crosses. Gold down 1.3%. WTI crude up 70 basis points to kick us off on a Thursday where I say now's the real test. We made highs. We had this kind of event last week, the big de-risking, the big taking down of gross across books, the Reddit, GameStop options phenomena. So we're chugging along, and then that comes around. Hedge funds have to de-risk, people taking risk down across the board, quick vol spike, VIX gets up to the mid-30s or so and then fades. Markets pull back. They alleviate those overbought conditions that we've been talking about for the previous 2 weeks, right? So we come in today and, it puts me in a great position to title notes, to clients this week, to the extent of, near-term de-risking presents opportunity. And then what do we get? We get a 3-day rally. Okay, that's great. Like that. But now the real test to me is we've worked off those overbought conditions. We had this event. That event is likely past. Always hard to tell for sure, but it likely passed. So now can we get to new highs? That's the question, right? The support levels are the levels, them. February historically, using data on the S&P going back to 1950 is a down month on average. So we had this kind of event, this choppiness. Can we get to new highs? I don't care what happens historically. I care what happens now, but we have it in the back of our head. We're still above 340, so we're still playing for that 413. But the question is how quickly do we get there? And I think that'll be determined by how quickly we get back to new highs. We're close now. IWM close, Qs close, SPY close. We talked about it, but that to me is the test now. Can we get through? And if we do, that's great. For now, we're staying the course. Bullish view from a trend perspective. Hopefully you took advantage of the opportunity early this week, Monday, Tuesday, to add some exposure, especially in some of those beaten down names. And now you sit back, right? You sit, looking for names, looking for the best setups, managing risk. And if we get to new highs, I think that tells you can add another level of aggression. Market in a minute. What are we writing about? Stocks rise but fade into the close of trading. Software and services. Position for new highs. I think that would be a key, right, as we're talking about it. I'm not going to go through it in the slide deck here, but I do go through it in detail in my notes. So have a look at that. And if you don't have the note, sign up for the trial. I'm screening for relative breakdowns today. And so we'll take a look at that. Breadth improves after the hedge fund de-risking, and futures point to a higher open today for the NAS, flat for the SPY. Taking a look at the major indices now from a power bar perspective, Dow Tax on 12 bips, 9-4 bulls to bears. S&P flattish on the day, 142.61. There's your NAS down on the day, but still better than, well, it's 2-1 bulls to bears, 28-14. 789 to 96 bulls to bears for small caps that outperformed yesterday. Bonds under pressure, yields going higher. It's interesting for all the people out there who are making top calls in the market, and there are a lot of them, and not exactly seeing a flight to safety in treasuries or gold for that matter. Energy, your best sector yesterday. Remember, for the past couple of days, I've been saying energy looks overdone to the downside. I actually highlighted it in one of my notes this week. Energy looks overdone to the downside. Snap back right on cue, 4.5% to the good, 3-1 bulls to bears there, according to the Chaikin Power Bar. Small cap stocks and large cap stocks strongly bullish. Now, I said we would screen for relative breakdowns, and that's what this looks like. And you know, the way I think about it is there's a lot of ways to manage risk. Volatility based with ATR, you can use a fixed percentage, you can use purely technicals, right? Support and resistance levels, trend lines, moving averages. But I think everybody can agree that a breakdown in relative strength is something you want to pay attention to because it becomes a drag on your portfolio. If a stock begins to lag the broader market, you're better off just owning the broader market, right? Why are you picking stocks if you're going to own stocks that are lagging? It makes no sense. At the same time, there's an opportunity cost, right? While you're owning a laggard, there are other stocks out there that are leading that you could be invested in that could be benefiting your portfolio. So what I did here today was pretty simple. I didn't care about the rating because, you know, market and model have to be in agreement for us to really like a name. So a name can have a bullish rating in our factor model, but if it's underperforming, not interested. So quite simply, let's take the Russell 3000 and let's screen for stocks with weak money flow, right? So they're under distribution and relative strength turned weak this week. And you get this list of names here that if you own them, maybe you want to understand why you own them. Macerich is kind of interesting. It was one of the highly shorted names that popped. So you might want to take a look at that. But, you know, Jacobs Engineering is a bullish name. You can see some bullish names on there that are starting to lag. CACI, CACI, across the board. So screenshot this, print it out, load it into your list. If you own these names, Tootsie Roll, another one, right? Another one of the short squeeze names. Probably want to think about why you own that if you do. Sunrun, another one, starting to lag after being a big leader. So you can see it here. Take a look at it, screenshot it, come back and watch the video. I think if you're looking for sources of funds, if you own these names, you have to question why you own them. Kroger, right? Interesting. But take a look. Some relative breakdowns. Let's look at our sector tracker now. 3-day bounce in the market turns most of these things green, but for staples. And I guess that's encouraging, right? Because if the market is bouncing and a defensive group like Staples is at the bottom of the list, we like that. As a matter of fact, we like seeing Utes towards the bottom. We like seeing REITs towards the bottom. Energy snapback, financial snapback. Our cyclical groups that I said, you know, are poised for a snapback. I didn't say it on financials. I said it on energy, though. Industrials, materials, top of the list. Comms gets a nice bump from Google and their earnings report. You know, solid board. Solid board. Staying opportunistic, staying nimble, staying engaged with the markets presented an opportunity this week. Hopefully you took advantage of it. Healthcare equipment services is our industry in focus. Past 6 months, been an outperformer, 10.4% to the good. Power bar ratio is strong, 14-9 bulls to bears. 17 of 21 subsectors down one slot over the past week. It's amazing you can have a strong power bar ratio and be 17 of 21. And think about what that tells you about the rest of the market and the health of the market in general. Hologic, Natus, and Orthofix, all with very bullish Chaikin power gauge ratings, all holdings of a fund that is up and to the right. That is a bullish rating, strong trend, oversold within the context of an uptrend. So if you're looking for ETF exposure, might be an interesting place to see if it fits. Bullish outperforming, bullish money flow. All the characteristics that we think are good in stocks apply to ETFs as well. Or at the very least, if you're looking for individual ideas, why not drill down on 14 names that have a bullish or very bullish rating and see how they stack up. Up and to the right is an uptrend, higher highs, higher lows. You don't have to take my class to understand that that's an uptrend. Let's look at what's trending now. Yesterday's movers and shakers, gainers and losers. Winner side of the board, Top four are all energy related. Don't really have much to say from a company specific standpoint, other than the fact that, energy snapped back. Like we said, it was due to do. And, big moves in some of the individual names. The ETF itself obviously is not going to move as much as some of these individual names. It's an average of the groups, right? Of the individual names. Up 4% though on the ETF. That's a solid day. Google up 7% following their earnings announcement. And let's go to the loser side of the board. PerkinElmer, in fairness, is a name that I had liked. I had highlighted it for our clients. Was in a nice steady uptrend, and then they ran into an earnings buzzsaw yesterday, down 7.5%. That's why we manage risk. Abiomed, no news there. EA earnings miss, down 5.5%. Caught a downgrade this morning. BIIB earnings take 5.2% out of that stock, and Illumina. Illumina is such a fascinating name to me. I haven't been able to get my head around. I haven't been able to get my head around it, though. It's fascinating. It's interesting. The genome is interesting. Down 4.5% yesterday. No real news. Let's dive into the charts. Breadth improves. Looking for a confirmed breakout. Remember what I said earlier, that the test is now, can we get to new highs? And with getting to new highs, we want to see some confirmation from breadth, right? So can we get some sort of a breakout in breadth metrics? Now, breadth metrics. Long-term breadth metrics still solid. I mean, they barely cracked, kind of went sideways, but they didn't crack much in the sell-off last week, right? Percentage of stops above their 200-day still, dancing around that 85 to 90% area. I mean, that's solid. We can't say anything bad about that. Remember, anything over 60 in our review is a healthy majority of stocks are in an uptrend for their time frame. Intermediate term, percentage of stocks above their 50, fighting to get back above 60%. That's above their 50-day moving average. So we'd love to see that happen for the intermediate term. Nice spike back with the rally this week, but we'd like to see it improve, right? We want to be over 60. Over 60 is healthy majority. Not shown here, but highlighted in my note. A snapback in the percentage of stocks above their 20-day moving average. Last week it was 28%. This week it's 39%. So still some work to do there on the shorter term time frame, but moving in the right direction. But again, we want to see these things break out. We want to see these things get into healthy majority. Ideally, we want to see them back at highs with the market. And AD line falls in there as well, right? It's been done a good job of telegraphing breakouts in the past. So we want to see the AD line making new highs with, or ideally ahead of, the S&P 500 to give us confidence that it is going to do the same, or it may do the same. Rest of the world rebounds with the U.S., right? This was an interesting trade as well. You've heard, people who've been following me, watching me, reading me, know I'm bulled up on markets outside of the U.S. Selectively, but broadening as well. If you don't care about that, that's fine. You can use it as a sign for equities as an asset class, right? Remember what I've said. I think we're closer to the start of a cyclical bull. Here's 2018, and here are global equities doing nothing for 2 years, and then just recently breaking out in November. Closer to the start of a cyclical bull. De-risking pulls us back to the 50-day where we bounce. RSI held bullish ranges. And on a relative basis, relative to the S&P 500, we have a breakout, a little consolidation here. So if we can see this breakout level hold, for those who are a little more intrepid, having exposure outside of the U.S. may make sense if it fits your portfolio, if it fits your view. Here at Chaikin Analytics, I monitor 47 different country ETFs. 14 of them are very bullish or bullish. China, there's 2 different Chinas and 2 different Indias in here. But what's interesting to me is, of these 14 ETFs over the past 12 months, look at the RRG. 13 out of the 14 are outperforming. Take us for a test drive. I'm back tomorrow.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.